Hello, Chapter 3 transaction review, specifically the journalizing for those transactions. I'm just using a blank master sheet to do this. Using the transaction list from Chapter 1, same transactions that we're dealing with in Chapter 3. I'm going to use the numbering right here as the dates for it, and I'm just going to make up a value for the dollar figure that's for each transaction. All right. The last one, we're not going to do this bought insurance on account because you never do that transaction, although it is possible. I'm not going to handle that one. Okay, first one, receive cash from the owner as an investment on the first of the month, say 2023, February 1. From this point forward, you only write the number of the transaction for the day, not the month of the year. Okay, receive cash from the owner as an investment. Let's just say we received $10,000. Make sure that you put the dollars, the figures in the correct space, and represent the change with two zeros or a dot. All right. There we go. Cash going up makes assets go up. At the same time, you don't owe money on the money you just invested. So capital, the owner's name, that account could also go up. Capital normal balance credit, so that would be your credit. Capital goes up, owner's equity goes up. Cash goes up, assets goes up. This is receiving cash for something other than a sale. So this would be a receipt. So it would be R1. Okay, so that's the first one. Transaction 2, paid cash for supplies. It's on the second of the month. We're going to go ahead and put 2. Notice the month and year we did not put. Paid cash for supplies. Let's just say we bought $300 in supplies. That means we spent $300 in cash. Anytime you pay cash, you're going to be writing a check. We bought supplies. Supplies account right here. We're going to make that go up with a debit of 300. Cash goes down, making assets go down 300. Supplies goes up, making assets go back up 300, and it's a wash. This is paid cash, so it would be a check. So we'll start with C1, check 1. All right. Next transaction, bought supplies on account. Other way you can get supplies, pay for it later. We know we're buying supplies. It's on the third of the month, so let's go to that. We know we're buying supplies. It's a sales invoice because we are buying. Oh no, I'm sorry. This is a receipt. This is no. This is a memorandum. I'm so sorry. This is a memorandum. Okay. Bought supplies. Let's say we bought another $200 in supplies. There it is. And we bought it on account, meaning we owe for an accounts payable. This is this 2-line one. So we're going to put right here, accounts payable. So XYZ business. And we need to make that accounts payable liability go up $200 worth of credit. There's your credit making your liabilities go up. And there's the debit making your assets go up. Notice the date in the source document is not on the second line. And that's purposeful. So we bought on account. Next one is paid on account. So fast forward one day, we're going to pay on account. Let's just say we pay off all $500 of supplies that we just bought. Cash is credited, $500 making assets go down. At the same time, you need to make your accounts payable go down. We only bought 200 from that company, but I said we bought 500. Just go with it. Let's just say we had 500 that we need to pay back to them. And in that case, here's your credit. Your debit to make the accounts payable go down, 500. A debit to a liability makes it go down. A credit to an asset makes it go down. And this would be paid cash, so this would be check number 2. All right, that's the fourth transaction. Skipping the fifth one, we're going to go to the sixth. Pay cash for insurance. All right, pay cash. We know cash is going to go down. It was done on the 6th of the month. Let's say we bought $250 in insurance. Cash goes down with a credit, making assets go down. At the same time, we need to make insurance go up, prepaid insurance, and we are going to debit insurance $250, making assets go back up. We paid cash, so that would be a check. So it's C3. So at this point, we've used 3 of the 5 source documents. We still have register tape and the sales invoice to use for transactions. Okay, next one, receive cash from sales. This would be your register tape one. Okay, so we made a sale, which is a credit, and we received cash, which will be a debit to cash. So because we're going to be over in these 2 columns and nothing's going to go here, we're going to go ahead and put a check mark here and a check mark here. And this signifies that we didn't forget anything, that nothing is supposed to go here. So this is purposeful, and this needs to be here. And this gets explained in chapter 4 when we do the posting. Okay, so let's just say we made $5,000 on sale. Sales goes up $5,000, making our owner's equity go up $5,000. Our cash goes up $5,000, making our assets go up $5,000. This would be register tape. So it's a T for register tape. And it would be the total for that day is what we would post or put as an entry here, rather. So it's done on the 7th. So it's T7 for the 7th of the month, register tape. All right, coming back here, receive cash from sales. All right, sold services on account. This is the other way to make a sale, is to get money later for it and to sell on account. Let's say we sold another $2,000 of sales. It's done on the 8th of the month. Sales is going to go up $2,000. We made a sale, making owner's equity go up. We did not receive cash yet. Somebody bought it on account. So we're going to say accounts receivable, and we're going to receive some money. Let's just say we sold to ABC Business, and they owe us $2,000. So debit to an asset makes your assets go up. Credit to sales makes your owner's equity go up. And this was a sale on account, so this is your sales invoice, S1 for your first invoice. All right, so that's that transaction. Only a few more left. Receive cash on account. Let's fast forward one day, and we're receiving the money that we are due on account. So our cash goes up. Let's say they're paying us $1,500 that they owe us. Cash goes up $1,500. That's your debit, making assets go up. And we need to make our accounts receivable go down. It went up $2,000. Now they're paying off $1,500. So we're going to make that mark over here, the credit. So they owed us $2,000. They paid $1,500. The difference is $500. They still owe us. Let's see here. And this is accounts receivable, ABC Business. And for this one, it would be a receipt. We're receiving cash on account. It is actually receiving it for something other than a sale. All right, receiving cash on account. So these are the 2 places you would use a receipt: receiving cash on account, receiving cash as an investment. This is the only time you'll use a memorandum, when you buy supplies on account. Checks are for when you pay cash. And register tape is when you sell services for cash. You sell and get cash right away. Okay, that was transaction 9. Let's do paid cash for rent. Should be a pretty easy one. That's going to be a check for it because we're paying cash. It's done on the 10th of the month. Cash is going to go down the amount for the rent. Our rent is $750. So assets goes down $750. Over here, the debit will be to the expense rent account. And that account needs to go up. It goes up with a debit, which in turn makes owner's equity go down. So as expenses goes up, owner's equity goes down. As cash goes down, assets goes down. Okay. Next one is pay cash for telephone bill. It's just like the pay cash for rent, except you're going to use a utility expense account. Then on the 11th, you'd be using a check to pay cash. This is for your expense utility account. Let's say we had $300 in utilities. This will make our expense account go up $300. A debit, making owner's equity go down. And cash is going to be credited, 300, making cash go down, assets go down. Okay, last transaction is paid cash to the owner for personal use. This is your drawing account. It's just like expense account, except it isn't an expense account. It's its own account. It's for taking money out for personal use, where expenses are for operating the business. Okay, either way, it was done on the 12th, and we are paying cash, so we know it's a check. It's going to be C6. We paid cash, and we took out $150 for personal use. Cash goes down, assets goes down. The drawing account, owner's name, just like expenses, as this account goes up with a debit, owner's equity will then in turn go down. So expense goes up, owner's equity in turn goes down, cash goes down, assets goes down. Okay, those are your transactions. They don't show you how to deal with when you reach to the bottom of a page and to carry forward to the next page. There'll be a little review for that after this. Have a good day.